Happy Bitcoin Wednesday, freaks. It's your boy Odell here for another SIL Dispatch, the show focused on actionable Bitcoin and freedom tech discussion. As always, Dispatch is funded by our audience. We have no ads, no sponsors. It is brought to you, it's brought to all of us, thanks to the wonderful audience who continues to support the show using Bitcoin. The easiest way to support the show with Bitcoin is to go to silldispatch.com/donate. You can donate with on-chain Bitcoin or Lightning. You can also donate via my BIP47 reusable payment code that is attached to a paynim that you can pay with Samurai or Sparrow. That paynim is easy to remember. That is Odell. Last but not least, you can support the show using podcasting 2.0 apps like Fountain Podcasts, Echo LN, Breeze Wallet, and many others. They work like regular podcast apps, except you load them up with sats ahead of time. You load them up with Bitcoin ahead of time. You choose how many sats per minute you think the show is worth, and those sats stream directly to my Lightning node. You can also do something in podcasting 2.0 called boostograms, where you choose an amount to send and you attach a message to it. Every episode, I read the top 4 boostograms from the last episode. Our last one was an emergency bank crisis episode with Dylan LeClaire on Sunday. We have Eric99 with 50,000 sats saying stay humble and stack sats. Great advice. We have at Councilman Jam with 10,000 sats saying not sure how to phrase it, so I just say great app. We have Ride or Die Freak 8 Mithrandir with 7,777 sats. If you're not paying attention, you probably should be. And we have at Fightless Birds with 5,000 sats and an orange heart. Also, freaks, I know it's a bear market. I know we're probably already in a global recession. We might be going into a global depression. Sats are hard to come by. If you can't spare any sats, you can also support the show by joining our live chat. Our live chat is on YouTube, Twitch, and Matrix. All those links are at silldispatch.com. We're the only show I know of that has an interactive live chat where your chat is streamed out to everybody else and can be viewed after the fact. So I consider you all hosts. So thank you to everyone who joins us for the live shows. You guys make it unique. Also, just subscribing on your favorite platform. Dispatch is available on every podcast app, Twitch, Twitter, Rumble, Bitcoin TV, YouTube. Subscribing helps. Sharing with friends and family helps. Leaving reviews help. All those things help. So thank you all for supporting the show. I also want to apologize. It's been a very exhausting last few days, so my brain is not working 100%. So I might be a little bit slower today. But we have a great guest in town in Nashville at Bitcoin Park, return guest. He was on episode 3 of Dispatch with Gigi. Then he returned for episode 23 of Dispatch with Gigi again, but also Gladstein. And now he's here by himself during this global bank crisis in Bitcoin Park, sitting across from me. We have Jesse Myers. How's it going, Jesse?
It's going great. Thanks for having me. It's bizarre to be at Bitcoin Park sitting across the table from Mr. Matt Odell. Thrilled to be here.
It's a crazy week.
It's such a week. You've been busy this week. I've been busy this week. It's been, well, of course, one of those weeks where all hell breaks loose when you're busy. And this is, I think, the point in time that we've been waiting for as Bitcoiners since the Fed pivoted 14 months ago. So that now is the next changing of the tide.
Well, I feel like I've been waiting for this since 2008 before Bitcoin existed.
That's true too. Like if we zoom out a little bit further, this has been the inevitable point in time that everyone who was at Occupy Wall Street or skeptical of TARP or anything like that has been waiting for, the next point in time when the can has to be kicked again.
And I feel like there's a lot of told you so's that are going around, but I said historically that I would not do told you so's because I've been calling it since 2008. I've just been wrong this whole time. So
Being in Bitcoin is one giant waiting to be able to say, "I told you so."
Just don't fucking dance.
Yeah.
So where should we start? What do you want to? When I had Dylan on, they took Signature Bank out behind the shed and shot it. So I'm kind of hoping. I'm not hoping. That'd be the wrong word, but we might have a bank failure while we're live on air twice in a row, which would be pretty ridiculous.
It would be auspicious.
So let's talk. Let's just quickly. What are your thoughts on the first three banks that failed? Silvergate, SVB, Silicon Valley Bank, and Signature Bank.
Yeah. So Silvergate and Silicon Valley Bank are sort of interesting, slightly different stories that make sense to me. And then the one that's really surprising is Signature, and I think that's a totally different story and a darker story, possibly. Silvergate, like what happened with them is that they had too much, all banks, all banks are fractional reserve. And so any volatility in inflows and outflows of deposits is amplified by that fractional leverage.
Right.
And so that's a risk to any bank at any time if there's a bank run. You add in the cyclical volatility of crypto and banking, having your banking customers be crypto companies. And then, in bear markets, everyone wants to get their money out of crypto. The people who don't, the Johnny come latelys are ready to bail in the bear markets.
Or someone like FTX, where like FTX was a major partner and they just blew the fuck up.
So I think Silvergate had built into their model. They were a better capitalized bank than most banks because they knew they were serving crypto.
They were almost fully reserved. I mean,
they had
like an 85% deposit drawdown that they survived.
I think they were doing everything right for their model and knowing that they were serving a more volatile industry. And then what they missed and what they got blindsided by was FTX. And so because they were the bank for FTX, that made it took a hit on their deposit base because suddenly that money doesn't exist. But then it also creates the bank run because everybody's like, well, we can't trust Silvergate to, what else have they screwed up? Regulators are breathing down their backs. Everybody wants their money out. And that becomes the pinprick that burst that bubble. So that makes sense. Silvergate screwed up by not realizing. I think what they should have caught is a little bit outside of the scope of what a bank is expected to catch. FTX was committing fraud and telling Silvergate that they weren't,
Right.
But
they survived for a while. I mean, the bank run on Silvergate started in November when FTX blew up.
Yep.
They had, they survived 90% of their deposits removed.
Yeah.
I think they paid out depositors in full, or they're still processing withdrawals over there.
Yeah. And
without any government assistance.
And the latest, it sounds like they're out of some crypto companies have come out and said they're making people whole.
Like they're still sending them out now.
Yep.
They're like going through it and closing out their positions and paying people out.
And I think the latest rumors that they might be trying to right the ship entirely. So I don't know what'll happen on that saga.
Okay, so let's put that behind us.
Yep.
Because we covered a lot of this with Dylan, so I want to get ahead of it, but I also want your opinion on these things. So then Silicon Valley Bank,
similar story for different reasons. Their mistake wasn't banking FTX. Their mistake was so they grew their deposit base by I think 200% or so. I think they were at around 60 billion in deposits
in like 2020, and then they went to 180 or something.
Exactly. Right? So they grew by 120 billion. So massive growth there. And what a bank has to do is put those deposits to work. They have to lend them out to somebody in order to get a return.
Or at least fractional reserve banks. That's what they do.
Exactly.
Which is all banks now.
Exactly. And so what they did, because they couldn't possibly put that much money to work all of a sudden, is they put 80 billion of it into treasuries. So at I think 1.5% yield.
And there were 10 years, right?
10-year treasuries. So That is
They lent money to the government for 10 years
Yep.
at 1.5%,
Yep.
which
So
they thought was a great rate
that's
a year ago.
exactly. And so that's a decision you make if you're not at all expecting interest rates to go up to 5% in
And
the
you
following 12
expect
months.
deposits to continue to go up. And like what you mentioned earlier when you were saying banks that bank quote unquote crypto companies or Bitcoin companies is more volatile deposits. Silicon Valley Bank, by the name, you could tell it's venture companies and venture funds, which also have a volatile characteristic to them, right?
Yes, they do. They are more cyclical with VC funding cycles. Like, when VCs are able to raise a lot of money and then put a lot of money into companies, and companies have big war chests, everybody's happy. That's
When
all.
government's printing money, rates are low,
It works.
you're just getting flooded with
Yeah.
deposits. And then when rates go up,
The
all the funding starts to dry up. Companies start pulling on their reserves.
Exactly. So if you raised $10 million and now you're in this new environment, no new money's coming in the door, you're having to pay things. You're trying to execute on your growth plan, pay employees, and you also know that there's not going to be any new money coming for a while. So you're starting to pull deposits out. It creates that the tides going out in terms of your deposits. It's of course less volatile than the crypto cycles, but
Right.
it's also cyclical in nature. And then so what they screwed up is that they socked away $80 billion for 10 years at a 1.5% rate. And then, a year later, those treasuries that they're holding on their balance sheet are worth a lot less because rates are now 5+%.
Right.
And then because of all the deposits going out the door, they had to dip into this. They had to sell. They had to liquidate part of this 80 billion that they weren't expecting to have to touch for 10 years. And so they sold a quarter of that and realized a $1.8 billion loss in that sale.
Right, because rates went up.
Yep.
So the current value of those bonds was down.
Yeah. So, at the end of the day, a bond is just a contract that promises to pay this coupon of yield. So, like if you were to put in $1 million into a 10-year bond that pays 1.5%, you're saying, okay, I'll give you this $1 million and you give me 1.5% return every year for 10 years. And then you pay me back the original original $1 million. So in that process, you're getting a 1.5% every single year return. And that's the contract that you're going in on.
Right.
And of course, after the fact, you can sell that contract to somebody else. And the sale price, if rates stay at 1.5%, then you're able to sell that at $1 million. But if rates go up, but your contract still is only offering a 1.5% return every year, then you have to sell it at less than $1 million in order to
Right.
compensate, to offset the foregone interest yield.
And if rates go the opposite, then you're at a premium.
Exactly. So when rates go up, your bonds sell for less.
Right. And then meanwhile, the Fed went on this massive tightening cycle, massive raising rates, like at a speed we've never really seen.
Ever.
Yeah.
To go from effectively 0% to 5% in 12 months is outrageous.
And they caught most of us off guard. I mean, there's this cursed tweet by Marty that he was just like, they will never raise rates.
Yeah.
I was like, Marty, you can't speak in absolutes. He's like, well, if they do, it'll be barely or
Yeah.
whatever. And then they just went for it.
So I run a little fund, and at that time, I was, my monthly updates to my investors were they if you look at the math, the system can't handle raising rates. So they're boxed in. They're painted. The Fed is painted into a corner. They can't possibly raise rates. If you just look at the interest expense on the national debt, we have $31 trillion of national debt now. And remember what Volcker had to do to break the back of inflation in the end of the 70s was to hike interest rates, Fed interest rates above inflation rates. And so that meant getting interest rates to 15% in 1980. And a year ago, we were looking at inflation rates that were 8%.
The official numbers.
Yeah.
The real number is significantly higher than that.
The real number is double that or more even. And so if you have inflation at 8%, to break the back of inflation, you're going to need to set your interest rates at 10%. Okay, so what would that mean for interest expense on our national debt? We have $31 trillion of national debt, so that's $3.1 trillion a year in interest expense alone on your national debt if you let your interest rates get to 10%. And we're already, as a country, our record tax revenues was 2021, where we brought in $4 trillion of tax receipts. And we've still been running a $1 trillion deficit on average every year for the last 10 years. So, we brought in $4 trillion in 2021. We spent $5 trillion. You're talking about adding another $3 trillion of expense, which would mean if you use those 2021 numbers, and that's as rosy as it gets, because that's in a bull market where you've got capital gains taxes helping out on the tax receipt side. You're talking about $8 trillion in expenses on a $4 trillion tax receipt base. So spending twice as much, which means $4 trillion of deficit spending has to come from somewhere. You print that as new debt. You can be fancy about how that comes out, but at the end of the day, that is money printing. Deficit spending has to come from money printed, and that adds to our national debt and makes the situation that much worse. That's the whole debt spiral we are in. So a year ago, it looked like it was not possible.
And besides that, I mean, also raising rates would result in crashing markets.
Yes.
And potentially breaking other things that we couldn't even necessarily comprehend the repercussions of. So they would never do it.
Yeah, and
then they went and just Leroy Jenkins.
That's what they thought. Yeah, and I still don't know if they genuinely believed that they could do it. Like, I don't know if Powell thinks I can be Volcker, like I've got the backbone to be Volcker and pull this off, or if it was, and that would be delusional. I think a reasonable stance could be like, our only shot is if we tactically try to shock the market by raising rates and try to bring down inflation, and then once inflation
flush out some bad actors, right?
Yeah, try to just
like the Carvanas of the world, FTX,
exactly.
right? Like just suck up a little bit of liquidity, like
take out some zombie companies, try to soften spending a little bit. The amount of purchasing that was happening a year ago after all the pandemic stimulus was impacting inflation. We've reversed that trend now. People are spending less. So there's this very narrow window where they could pull off a soft landing. You could shock the market with interest rates for a few months,
or at least they could think they could.
There's a
I don't think there was no path.
So I think it's feasible to have abated inflation a little bit, just contracted a little bit and then stopped. But I do not think the Fed has the tools or competence to actually find the right timing
and execute
on that, because they were a year late to start hiking, 18 months late to start hiking interest rates when they put out all the pandemic stimulus, right. and things started to run hot. They should have been raising rates right then.
That point, inflation was transitory.
Yeah, right. And instead of raising rates for the first 12 to 18 months that they should have been, they were denying it by saying that this doesn't line up with our Keynesian model of the world. It's got to just be transitory. So they're not capable of executing the kind of tactical interest rate hikes that they embarked on, and now we're perilously close to it being too much and triggering a depression.
Awesome. And it's interesting because there was so much craziness. There's always so much leverage and bullshit in crypto markets. We saw the signs first, right? We saw DCG get fucked. We saw FTX go down. We saw all this liquidity get pulled out of the market, and it kind of hit these really speculative things first, which is in our realm. And then, so there's a lot of narrative shifting that's going on, blaming Bitcoin or blaming quote unquote crypto. But my perspective, and I'm curious on your perspective, is that it was more of just a canary in the coal mine kind of thing. It's not like, as much as I hate shitcoins, like shitcoins didn't cause this. Bitcoin didn't cause this. They were just where a lot of the games were being played and where liquidity got pulled out at first because they were considered more speculative, more risky bets.
Completely agree. I think that the nature of this market is one that reacts more quickly. It's a smaller market. It obviously moves faster because it's 24/7. It's, people who are mainlining the internet all day, every day. So information moves fast, sentiment moves fast, and it's the most liquid thing in everybody's portfolio. So if you are, and this is what we saw in the COVID crash, the March 2020, March 12th, 2020 crash that wiped out so many leverage funds, was when everybody needed to scramble to get cash, you sell your Bitcoin, or your Ethereum or whatever.
Bitcoin, well, I don't want to group them together, but
Yeah, but
we see Bitcoin fall first in these types of crisis moments.
and from a more macro point of view of, like, if you're a hedge fund on Wall Street and you've got some tiny little segment of your hedge fund that's dabbling in crypto, and let's say you don't understand really what you're dealing with, so you've got some Bitcoin, you've got some Ethereum, you've got some Solana because your hedge fund is connected to the VCs
Is
that
multi-coin, and
pulled
now
out
you're
that shit.
bankrupt.
Yeah,
You're getting
exactly.
sued by your LPs.
So those guys, in March 2020 were like, shit, we need cash, we need it now, sell all the crypto, lumping in Bitcoin with everything else. So yeah, this market just moves faster, it reacts more quickly, and it gets washed out. So we've already been cleansed. The tide has gone out. We've seen who's swimming naked. The zombie companies have already been screwed. The Ponzi's like FTX um, have gotten their due already, and the traditional economy is a little bit slower for the tide to go out. So I think it
Now we're
is
on
still
the
going up.
TradFi Ponzi's are
Yeah.
getting wrecked.
Well, the TradFi Ponzi's are the fractional reserve banks, and they are too big to fail. So some of them will get wrecked, and ironically, it is the bigger ones, the ones that were the big problem in 2008, that are now being promised protection by the Fed,
Well,
by
so let's talk
FDIC.
about this, because this is what broke while I was on with Dylan on Sunday, and we didn't really have any time to digest. We were just like, we were literally reading the press release on air. They announced on Sunday that they were shutting down Signature Bank, backstopping all deposits on Signature Bank. So all depositors were made whole on Signature. Shareholders were zeroed. So if you own stock in Signature, it was worth nothing. Leadership was culled and removed. And the same thing, SVB had already failed at that point, but the same idea with SVB. Depositors made whole. They have this line, no taxpayer funds.
Yeah,
However that's
I
possible.
love that one.
But different than the bailouts that we have, and you already see the narrative. It's not a bailout or whatever,
Because bailout's an unpopular word after 2008.
but it is that part of their announcement is structurally different than the bailouts we saw in 2008,
Yes.
because they removed leadership and they zeroed out the shareholders.
Yes.
But then they added this other component where any banks that had these treasuries, these longer dated durational treasuries that were trading at a discount, could loan money from the US government at par. So like when you were saying the $1 million bond that's trading at 600,000 or whatever, they could borrow $1 million off of that, and they say for a year. Nothing's more permanent than a temporary government measure, but they say for a year. And what that was a straight up bailout of all the remaining banks.
Yes.
Ahead of time.
Yes.
If that existed, SVB never would have failed in the first place.
Yep.
At that point. So they're picking winners or losers. They're not removing shareholders or leadership on those banks that they provided that to. But then at the same time, so I was just straight up a fucking bailout for every bank preemptively.
Yep.
And then at the same time, they were basically signaling to the market, though, that if you're a shareholder, you could get zeroed. You could get pulled behind the shed and shot. So the next morning, we still saw all the stocks go down tremendously. The equity positions in these banks were going down a lot, which obviously scares the shit out of people. I mean, they should have been scared already, but it scares the shit out of people. And then the runs continue. People continue to move their money out, and they think, where can I send my money? Probably only the top 4 banks, because those will definitely be saved, right?
Yep. Right. And so we've seen JP Morgan, Citi have a sudden growth of their customer base and their deposits.
And Bitcoin went up 20% at the same time.
And suddenly it's like this Bitcoin thing makes a lot more sense to a lot more people.
I had a lot of friends that like were on the edge or whatever that just have completely,
like in the last week,
they completely. I was setting up cold cards this weekend.
Oh wow, good. Yeah, it
wake up call.
And you know that my network is my MBA friends and folks from management consulting from my past life. And I wouldn't say that they're orange pilled now, but there's been an uptick of like, this is kind of in line with what crazy Jesse has been talking about, you know?
So that's where we currently stand. There haven't been any, I guess, First Republic. What's happened with First Republic? Did you follow that at all?
Yeah, not closely enough. There's been obviously a run on First Republic.
The small regional banks or the
small regional banks. First Republic in particular has been hit pretty hard, and has sold off quite hard, but is still so far whole as far as I know. I don't know enough about that one.
Yeah, I don't think they fully went down yet.
Yeah, it does look like. I think the most interesting thing to watch is the credit default swaps on banks, which, for your refresher on what those are.
Yeah, we're just all simple Bitcoiners over here. We just stay humble and stack sats.
Those are the instruments from The Big Short, from the 2008 crisis, where Michael Burry and those characters were buying these contracts, credit default swaps, that are betting against the solvency, the viability of the banks, and those are what paid off. They were buying those against mortgage-backed securities, and then when the mortgage-backed securities were suddenly not viable, then the credit default swaps, or the insurance against the mortgage-backed securities, pay off. We are seeing credit default swaps on a few banks start to float upwards, meaning it's becoming more expensive to buy insurance on.
You can think of CDs, credit default swaps, as insurance.
Insurance against failure.
But it's like market priced insurance.
Yeah, right. And so these are contracts that trade. And Credit Suisse has been shooting upwards in terms of its 1 year. The 1 year credit default swap, meaning the chance of failure in the next year, has like 20x in the last week. So the market is seeing something there, and
and the stock is at an all-time record low. Period.
Yeah.
One of the biggest banks in Europe.
Yep. I think Credit Suisse is down 27% today, as we're speaking. So there's,
and these markets are rigged, so they just keep halting trading of all these stocks as it's happening.
Yeah, they have these circuit breakers to slow it down, but then when trading reopens, the idea there is that if you stop a panic, so if people are being irrational, then you get rid of that. But then if there's something real, if it's not panic, if it's actually like probable.
We have Space DD saying it's minus 13% right now.
Oh, maybe that was from yesterday then.
But then they reopen trading, right? And then it keeps going down.
Yeah. So they're selling off like crazy. And
By the way, freaks, just a reminder, Bitcoin has no circuit breakers. It trades 24/7.
yeah, and that's part of
As it
why
should be.
it washes out faster, right? So
Right, we saw that in 2020. They were actually halting the entire S&P during that March 2020 dip.
yep.
But
Whereas
Bitcoin just
minus
liquidated
50%.
everybody
Yeah.
that was trading, at least.
I'm trying to find the 26% I saw, but
But all the big so the word of the day or the word of the week is contagion,
yeah.
right? And talking heads will always go out of their way and say the worst is over, there's nothing to fear, and that's what they were saying yesterday. And then we essentially woke up to European markets in complete panic.
Yeah. And it's all because of the same driver of this mismatch of duration of your assets and your liabilities from a bank's point of view. A fractional reserve bank, that's their bread and butter. They have to figure out how to balance having enough cash on hand to serve withdrawals at any point in time, and that's all just formulaic, like how much you expect, your standard deviation spike of withdrawals at any given period, and then your risk tolerance for how much you should have on hand in order to serve that. And banks everywhere are underwater on the treasuries, or European bonds that they purchased a year ago when markets were running so hot and deposits were flush, and they had to put them to work somewhere, and they, they put them into sovereign debt, um, you know, treasuries or European bonds, and now those things have sold off. And because these banks are typically uh, 25x leveraged, they're Greg Foss was talking about this yesterday, that they have, their fractional reserve to such an extent that it equates to 25x leverage in moves,
It's insane.
for the value of their securities that they've used deposits to purchase.
In practice, it means no bank can survive the majority of their depositors withdrawing, basically.
Yeah.
Or few can. I guess
Oh, yeah.
Silvergate was the overwhelming majority. They were still surviving for a little bit.
Yeah, I think the majority of depositors withdrawing is well beyond the models that any bank is expecting. I think it only takes a few percent beyond what you typically expect in a given month for it to start to be a problem. Because of the requirements being at 0%, like since the COVID pandemic, the COVID crash in March 2020. Regulators said, "All right, banks, you don't have to. Your new reserve requirement is 0%." So that's been the law of the land for the last few years, and they haven't changed it back. And that's just to allow banks this extra cushion of not having to have any specific deposit on their books at any given time in order to be good in regulators' eyes. But that means that we've been extra risky, extra susceptible to a bank run since March 2020, because the banks get this updated guidance of you only have to have 0% reserve at any given time.
Absolutely insane.
And they go, all right, cool, we'll just jack up our risk by buying more long dated treasuries, and then the market moves against you, and any influx of withdrawals suddenly means you have to liquidate underwater secure bonds, and realize, like Silicon Valley Bank did, a $1.8 billion loss, and that massively hurts your financial position and your shareholders' trust in your abilities to manage your bank, and that precipitates a bank run and also simultaneously a sell-off of your stock. So this is all happening to everybody right now because of this systemic problem of rates being super low a year ago when everybody had a ton of deposits. And so you put your deposits to work in a safe bond, getting as much as you can, 1.5% or so. And then fast forward a year, and all of those long dated bonds are massively underwater while you're starting to have a bank run. So this is a problem that everybody is facing, every bank is facing, because of how they let interest rates get so low and lulled people into a belief that they would stay there forever, because they should stay there forever based on the level of debt that um, the U.S. and Europe is dealing with. And then fast forward a year, they've created a recession.
And because the banks are Ponzi schemes,
Yes.
the way they're set up. And then, so a couple things. First of all, Space DD corrected himself. He said that's on the New York Stock Exchange, Credit Suisse. It's minus 20% on BYMA. And then he goes, I don't know how these foreign stock tickers work.
Got it.
And then Cantil and John said that CS is classed as systemically important to the global banking structure, and
Yep.
the Swiss central bank commented that they are ready to step in and save the bank,
Oh, did
support
they?
the bank.
Oh, okay. So that's new in the last few hours, I think, because the latest I heard there was that Credit Suisse was asking the Swiss central bank for support, like a statement of support.
I mean, this is just a freak in the comments, so I don't know. We have to verify that, but
Well, so maybe that happened.
but like this whole system, obviously freaks. Bitcoin fixes this. This is exactly why Bitcoin exists. Bitcoin exists because you shouldn't have to trust a company or government with your money. You should be able to have money without trust. You should be able to hold it yourself. You should be able to hold it without permission. You should be able to spend without permission. This is exactly why Bitcoin exists. And if you've just been staying humble and stacking sats, you hold Bitcoin in cold storage, you've been learning the best practices, you've been getting comfortable with it, you're in a very good situation right now. But all that aside, there's a global banking crisis going on. So I want to continue to unpack this. I have this comment in the chat. I was in some Twitter spaces and they said that the crash can only happen when people run to withdraw their money. If there's no withdrawals, then everything would just settle down. How true is this?
Yeah, that's actually true.
But that's ridiculous. Like, you should be able to withdraw your money from the bank.
Yes. So I guess Silicon Valley Bank, because the dust has cleared a little bit and we know kind of what happened, is the kind of the best example of what's going on, I think, everywhere. And in that case, we talked about how they had $60 billion of deposits. Suddenly that went up 200% in the space of a year. They had 120 new billion dollars of deposits. They put 80 billion of that to work in 10-year U.S. Treasuries at 1.5%. Rates go up over the last year. Suddenly, that $80 billion is worth significantly less. That's fine still from the bank's point of view, so long as you don't have to sell that $80 billion of long dated bonds until they're back above water.
Because they still have a portion that they have there for immediate withdrawals already.
Yep.
And then, so I mean, with Silicon Valley Bank, it was really interesting because it almost appeared like they were doing diligent risk management. They were attempting to do diligent risk management, failed on the execution. So the way the perception was externally showed a little bit of weakness, a little bit of trouble, right? They sold some of the bonds for a loss. Then they tried to sell some stock. And as a result, at that point, and the CEO made one bad comment. It was a really bad comment. Something like, as long as everyone doesn't withdraw their money, we're good. Something to that effect.
Yeah, just don't run.
Stock dumps 60%. And Peter Thiel goes out to all his founders with his fund, his VC fund, and is like, pull your money ASAP. And then this is a phenomenon that I've been talking about for months now, is this: we're in the era of social media. In 2008, when IndyMac was the first bank that went down and there was a run or whatever, you could only watch it in mainstream media. Like, Twitter wasn't even really a thing yet. In this case, in Silicon Valley Bank, people were tweeting about it. People were TikToking. People were texting their friends. It was immediately going into all the VC group chats. All the VC funds all those crypto VC funds and Silicon Valley VC funds. were telling all their founders to withdraw. They were all racing to withdraw, and they didn't even have to go to the bank to do it.
Hmm.
They were wiring, hundreds of millions of dollars out of this bank.
The social media risk.
And there's no negative for someone in that situation. I mean, you could go to a worse bank accidentally, but if there's a little bit, if there's even a tiny bit concern that your specific Ponzi scheme is the one that's going to get run on, you just withdraw, sit it out, and you can just send it back in afterwards if
Yep.
the dust settles and everything's fine.
Yeah, it's funny that like the crypto markets have learned more about the risks here than the traditional economy because we've lived through so many shocks.
And basically bank runs, like these exchange hacks, exit
Exactly.
scams, those are essentially bank runs.
Exactly. So we actually know more about this than people in the broader economy because we've lived through.
And there's never bailouts for our shit.
Yep. And so, and I think that's part of why. So setting aside that like everyone should hold their own keys and not have their money on BlockFi or whatever. But if you're still learning, if you're an idiot, whatever reason you're engaging in BlockFi and stuff like that, you've still learned that if there's any rumor, if there's any whisper of solvency problem, withdraw because there's no risk to you. You should withdraw as soon as you can.
And at least a lot of people, it's unfortunately, it's a lesson that has to keep being learned over and over again as newcomers come in. We saw a lot of cocky newcomers that got caught up in FTX and BlockFi, but there's a large amount of participants that understand that if you're with a custodian, don't keep more with a custodian than you're willing to lose.
Yep.
No one feels that way about banks.
Right.
The traditional people, I never listened to that All In podcast. But this one seemed like an important one because they were, Jason was in all caps on Twitter and shit, just freaking the fuck out. And they just couldn't even comprehend this idea that like their money wasn't in the bank.
That's amazing. I didn't know that. That's great.
Yeah, they had one on Friday as everything was falling to pieces. Yeah. And then Jason went on Twitter and was just in all caps like, this is the end of the world. Like the government has to step in. He was like, buy guns and ammunition. Like he was just like, he was completely lost his mind.
Yeah. Wow. Great. This is such a great little microcosm of how Bitcoiners and crypto people more broadly have had a crash course in true capitalism in a way that the traditional economy has forgotten. What is generally accepted wisdom is the product of what has worked in living memory, right? Like that's how we come across these maxims like stay humble, stack sats. That works. That
right.
works.
I didn't just like wake up one morning and I was like, stay humble, stack sats. Like I was not humble and I got wrecked.
Yep. And
multiple times.
And you watched other people get wrecked and you watched this keep happening and you figured out that this particular path is a path that leads to success and keeps you safe. So that becomes the wisdom of people who have learned in this market. And that's how it always works. To go on a little bit of a side rant, like that's why everyone tells you to get a mortgage and plow money into your 401k. It's because that worked over the last 40 years where we went from 15% interest rates to 0% and financial assets get bid up. So real estate goes up and your
let's just talk about that relationship.
Yep.
Rates go down. So buying a quote unquote a risk-free return in a short-term T-bill, a loan to the government for 3 months or a loan to the government for 1 year, that return is less because rates are down. And then because that is the case, people are looking for greater returns somewhere else. So then they go out and they bid up stocks, they bid up real estate, right? They bid up homes. The liquidity pushes out other places, right? That's basically the premise.
Yeah, I think it's a different driver. I think that is in parallel also happening. I think what you're sort of talking about here is like if you can buy a T-bill that's returning 15%, hell yeah, you're going to do that.
You need to outperform that 15% to invest in a stock.
Yeah, and so
Or
everything
invest in
else
a company or
becomes
buy a
a lot
house.
riskier, and you're more likely to be in the bond and stay safe that way. But at the same time, inflation is running hot too. It's maybe around 15%, and so you're ultimately just treading water.
FYI, Cantil and John just came in with a Don't Trust Verify, an official Swiss link that says that they will provide, the Swiss Central Bank will provide a backstop with liquidity to Credit Suisse.
Amazing. So this is the market in action of like the bank pleading for help from the central bank, and then the central bank within the space of a day responding with official support saying that they will in some way backstop it and try to instill confidence in the market.
Sorry for interrupting you.
No, yeah, it's financial market history, real time right now. So to get back to that though, you're going to sit in the bond because it's the safe thing during this time of turbulence, high inflation. And if you can get interest rates, if you can get a 15% interest rate, you're going to sit there even though you're just treading water.
And your real rate might be negative.
It might be zero.
If you're getting 5% on a T-bill, but real inflation is 8 or 12% or whatever, then you're actually losing 7%.
Totally. So I think that the real trend happens over time here. It's not so much about that moment in time when you're choosing the bond. It's about when rates are 15%. How does that impact the valuation model for different asset classes? So with real estate valuations, stocks are easier to do. So with stocks, the value of a company is its expected future cash flows divided by the discount rate that you have to apply to those cash flows. And that means the current interest rate or the expected interest rate over the time of those cash flows. So when you line up all of your, all of the expected cash flows by year for the next 30 years for a certain company, but you have an interest rate of 10% or more, something like that, and you're discounting the future cash flows based on that interest rate, pretty quickly, after like 2 or 3 years, the value of the future cash flows drops down to like nothing. So it doesn't matter in that valuation model how much cash flow you're going to have in 5 years. The math amounts to it not really mattering. But as you drop interest rates and you get closer to zero, suddenly the future cash flows, the cash flow that happens in year 30 is just as valuable as the cash flow that happens in year 1 because you're not discounting it by much. So that means that suddenly this company looks a lot more valuable in terms of its current valuation. So that's why as interest rates drop, the value of a company gets bid up because the people are just reacting to the math and what that does to the expected future cash flows. Sort of a similar story with real estate in regards to like your expected future cash flows of rental properties or commercial properties. But then the other driver there is mortgage rates. So as interest rates come down, mortgage rates come down. Suddenly,
general cost of capital comes down. You can borrow money super cheaply and then invest it in things.
So you can afford $1 million mortgage if rates are 2%.
Right.
But you sure as hell can't do that if your rates are at 10%. So therefore you're willing what you're willing to spend on a house is not $1 million at 10%. It's like 300,000 or something like that. Just based on the interest rates. So it's all very susceptible to what's going on with interest rates there. So that's why sorry to finish out that.
No, that's good.
Aside,
no, this is good. This is good.
Since 1980, 1980 over the following 40 years, if you look at the Fed funds interest rate, it started at 15%. There's noise along the way, but it's pretty much straight line for 40 years down to zero.
Right.
So people who bought houses in 1980, the boomers who were, our millennial age then, they got houses for cheap because interest rates were high. And so the cost of servicing that mortgage was high. And so the cost of the house couldn't be very high. They got in then and then watched interest rates come down.
Money get cheaper and cheaper and
Money
cheaper.
gets cheaper and cheaper. You can afford a bigger mortgage.
Asset prices go up.
Asset prices go up. As interest rates come down, financial assets, so that means stocks, but it also means real estate, it get bid up.
Right.
And that's the climate that we've been in for the last 40 years. And that's why the accepted wisdom that we've been told to follow is just get a mortgage and put money into your 401k, because that's what works.
Right. And the hidden thing is that inflation's running this whole time.
Yeah.
That people don't factor in as well.
Yeah. Yes. That's
because the
also
money's
happening.
cheap. Yeah.
Yeah. And so, but looking forward, so we've received this wisdom of you just do this.
Right.
Hey, millennials, just shut up and get a mortgage.
Right.
Like that's what we've been told to do. But now we're entering the winds have changed. The opposite is now has to happen. We're basically looking at 1970s stagflation, like at minimum, either that or something like what we had to do in the 40s to pay for World War II, which was just let inflation run hot for a while. That's what we have to do. There's no way around it. And so the asset classes that did well over the last 40 years will underperform in the opposite prevailing winds. So that they had a tailwind for the last 40 years, and now they're facing a headwind, and they're going to go sideways in nominal terms and down in real terms. I think that's what the math points to.
But isn't there another aspect here? At least let's go back to the house thing.
Yeah.
In America, at least, and this is not common in the rest of the world, it's very common for getting a 30-year fixed mortgage, fixed rate mortgage. Most of the world, they have variable rate mortgages that adjust as rates change, right? So your monthly payments go up when rates go up, and they go down when rates go down. If inflation is running hot, and we're in a situation we've never been before, right? Like we've never had this much government debt. We've strictly never been in this situation before of all these different variables. If inflation keeps running hot, which it seems like it will, because they can't significantly raise rates without breaking things even further, then is it that crazy to lock in a 6% 30-year loan?
Yeah, that's a good point, where interest rates could and probably will go up over the next few years. So, and we could end up with like 10% interest rates, and you're looking back at a 6%
because I'm not going to lend you money for 30 years at a rate that's significantly less than real inflation.
Yeah. And this, I guess, to put this in context, this comes back to like that fastest horse idea from Paul Tudor Jones of like, what was the fastest horse the last time these conditions existed in the 1970s? It was gold. So hard money was the thing to hold. It fucking rocked in the 1970s. And that's going to happen again. I think gold will do well, but obviously
gold's been kind of stagnant during this whole situation.
Yeah, and I don't know enough about the gold markets or the mechanics there to really speak on it, in particular because the ability to do paper gold manipulation is this giant elephant in the room.
Right. It's one of the main advantages Bitcoin has.
Exactly.
Is there's still paper Bitcoin, but at least you can easily hold it yourself. You can easily verify it yourself.
And when there's paper Bitcoin, so FTX.
And easily trade it yourself in large volumes.
Yep.
It's hard to trade large volumes of physical gold. Like, what are you going to trade $5 million worth of physical gold? Who you're trading it with? How many trucks are you going to use?
Right, exactly. So you end up having these promissory notes. These paper gold dominates the market, and Bitcoin has that advantage. And FTX did this.
They had paper Bitcoin. Yeah, we would have had 200K by conference day if it wasn't for that meddling SBF.
Quite possibly. I ran the numbers on that when that went under, and it looked like the amount of paper Bitcoin that they had promised And they had liabilities of X amount of Bitcoin. I forget how many
It was
tens of
over $1
thousands.
billion.
Yeah, it was 1.4 is the number I remember. It was, I forget, like 30,000, 50,000 Bitcoin, something like that. But then when you run the math on how much Bitcoin has been mined in the last year, ostensibly when this paper Bitcoin was created, that increased, quote unquote, increased the amount of new Bitcoin being created over the last year by 25%. So they added 25% to the
Of
newly
fake
created
Bitcoin,
of
yeah.
fake newly created Bitcoin. And that screws up your, to the extent that stock to flow is a real thing, that really
It's not.
messes with it. I think it is directionally correct.
Okay, well, before you die on this hill, so I have this thesis with Bitcoin that there will always be people playing games with paper Bitcoin.
Yeah.
But because of the properties of Bitcoin, and the properties being that you can easily self-custody it and you can easily verify it yourself with your own node,
Yep.
as long as people continue to stack, and I think adoption increases and more people will continue to stack, but even just the existing holder base, that stacker base or whatever, stackers are setting the floor. As they continue to stack, they will eventually expose these schemes.
Yep.
And you'll have kind of a bank run type of situation. Then the market will normalize, spot Bitcoin will take over again, and then it will rinse and repeat all the way up, basically, is my thesis.
Fully agree. I think that we will keep having new flavors of paper Bitcoin companies, Ponzi schemes that then get washed out. And I think you're right that, like, as the price of Bitcoin goes up, your liability, the size of your liability, if you've created paper Bitcoin, grows with it. So, like, if you promise,
Nearly exponential, is like insane amounts.
yeah, well, if you promised, if you have a 10,000 Bitcoin paper Bitcoin hole, right, like where
Right.
that's what you owe, and then the price of Bitcoin 10x's, it's as if you had
Or
100,000.
if we're in a post fiat world, like even the purchasing power goes up, whatever, you price it in cows or whatever.
Yeah, yeah. As the purchasing power of that,
Your hole gets bigger and
your
bigger
hole gets bigger and bigger in purchasing power
until you blow
terms,
the fuck up.
and eventually that the whole itself, in terms of the number of Bitcoin that you owe, can stay completely
It could
flat.
even go down.
It could even go down, and you become more and more insolvent and more unable to hide that. So it eventually will reveal itself.
And the FTX situation is a very obvious example because we know how much they owe users, and we know they had no Bitcoin on their balance sheet when they went down. But also, this applies to me. This also applies to things like BlockFi, which is like rehypothecation as a service. They were taking
Yep.
people's Bitcoin, and then they were lending it out to a counterparty who would lend it out to another counterparty who would lend it out to another counterparty.
Yep.
And that has the same effect
And what I
or
hope
similar effect.
what I hope happens, and this might be me placing a little too much faith in humanity and business people.
Many such cases.
Yeah. Um, is I hope that the examples of BlockFi and FTX make it,
And GBTC and DCG.
yeah, yeah, in different ways, make it a little harder for that to happen again. So, like, the surface area of grift reduces over time, because people wisen up to
They
how
get
you can,
burned and then they learn.
yeah.
At least some people do. A
And
lot of people won't, but some people do.
yeah, and the question there is, like, what percent of learning is retained over time, right? Like, will you totally forget the lessons of FTX 5 years from now? What's the
Well,
decay
that's what
on
happened.
that?
Like, people forgot Mount Gox, and I mean, you can go back in my tweets, and I was saying, "Not your keys, not your coins," very
Yeah,
simple tweets, and people were calling it FUD, and they were saying the market's mature and we're past that point.
yeah, but it's the newbies who never learned that lesson in the first place, right? Like,
Right.
Stay Humble Stack Sats comes from Mt. Gox and experiences like that.
Years of experience,
Yeah,
yeah.
and so the people who lived through that get that
At
Stay
least
Humble
some
Stack
do,
Sats.
yeah.
Yeah, and yeah,
Hopefully, the majority do. Or
and
they just lose all their money and then they
if they
walk away.
ignored it over the last few years, maybe now with FTX or in the banking crisis, they're starting to
My
see it.
point is, like, what, Gox was, like, 9 years earlier, right?
Yeah,
So you have, like, these
right.
time periods, and then anyone who came in, there was other failures after Gox, like MinPal, there was a bunch, right?
and the question is, how much do you learn from, like, how much do newbies learn from the lessons of Gox? In that elapsed time, like, I think the market got a little bit smarter, and that meant that FTX had to be a little bit more sophisticated in its deception. And I think that trend continues forward. So this is, in a way, Bitcoin and crypto more generally, as like with its properties as an asset class, um, creates this anti-fragility of like it you learn lessons that you wouldn't learn in a dollar
because
world
there's no bailouts.
because there's no bailouts,
No one's holding your hand.
and
No
there's
one's
no way to hide
no
when the tide
training
goes out.
wheels.
Yeah. Um,
That's why, like, people that there's some people that presumably learned their lesson because they didn't have access to their money for 72 hours at SVB. But there's a whole class of people that are like, I'm going to keep my money with SVB now. They're the safest place in town because the
yeah,
government has backstopped it.
right. Ironically, they've become a safer place because they have this official stamp that the government is going to protect them.
But like those people didn't learn their lesson partially because they got bailed out.
Yes. Yeah. So no less. Yeah, that's a great example. That
Like I had normies coming to me. They're like, "Oh no, my on like Friday." They're like, "Oh, my SVB wire will process next week." I'm like, sorry for your loss. I was because I'm used to, I haven't seen real bailouts since 2008. I've seen all these collapses. Like as soon as FTX started having issues or whatever, I was like, they're done.
yeah,
It's over. No one's coming to save you.
yeah.
It's gone.
You have a harder mental model of how this goes because in crypto and with Bitcoin and crypto, it's weird to lump them in with this, but
Yeah, I
like
hate that you keep lumping them in. I'm like, I'm rolling my eyes over here.
the lessons apply of like you get fucked to both, but obviously for one has merit and the other doesn't, but the hard lessons are true across both.
Yeah,
Um,
if anything, it's easier to learn a hard lesson quickly if you're playing the shitcoin games.
yeah, yeah, and that's how I ended up becoming a Bitcoiner. Was
Like
actually
there's connection here. There's some kind of metaphorical relationship between like yield farming yams and yield farming on SVB.
yield farming
You
yams.
remember like they
Oh,
had all
was it
the
yams a shitcoin or
yeah, well they had all the Ethereum tokens that everyone was yield farming
yeah,
like a year and a
right,
half ago.
sushi and things,
Yeah, they were all different names of foods.
right? The food
And you
token.
were getting like 40% staking yield off of them or whatever,
Yeah,
or liquidity providing yield.
and the Fed doesn't step in to backstop yams.
But they stepped in to backstop USDC
Interesting. That's an interesting
because
point.
USDC had billions of dollars on SVB. It's the first time
That
the
crypto
Fed,
is being helped by
yeah, first and USDC backs DAI, and DAI and USDC make the majority of the DeFi backstop. So they actually, this bailout is the first time we've actually seen federal government come in and protect the crypto ecosystem. I don't think it protected the Bitcoin ecosystem.
Yeah.
I think if anything, if USDC faltered there, which it looked like it was about to, there would have been a significant flight to safety to Bitcoin. It would have been a very big learning lesson for people that Bitcoin's the only stable coin.
Yeah.
And they kind of saved the Ethereum DeFi ecosystem by backing up USDC.
And I guess for a long time I've sort of viewed the stable coins as they're not even crypto. They are fiat with a crypto wrapper.
Yeah.
And so I guess it's not surprising that the Fed, FDIC had to step in to save.
I mean, they're
fiat.
Goldman and BlackRock backed.
Yeah. That's part of the fiat ecosystem. It's not even crypto. Yeah. But yeah.
Then it backs up the DeFi shit.
Yeah, it does. But as we know,
it would have been crazy to see like what and what happened is, so when you have these types of bailouts, is the next time is significantly worse and grander and bigger and more devastating. And like there was a lesson that could have been learned here, that trusted third parties are security holes, and you shouldn't back like the first letters of DeFi are supposed to stand for decentralized finance. Like if you back that whole ecosystem by a centralized third party that's backed by Goldman and BlackRock,
DinoFi,
the whole thing can just get destroyed overnight if that thing goes down.
Yeah.
And now that people didn't learn their lesson, so how much like USDC is like $40 billion under management or something. It's like $50 billion. Then the next time this happens, if USDC even survives this cycle, which I'm still not convinced it will, because you're a fucking idiot if you're holding significant amount of money in USDC right now. But it could be at 100 billion or 120 billion. Like, that's what I was saying about FTX when FTX fell. Like, we should be grateful it fell when it did.
Yep.
Because if it survived the cycle,
it would have been way bigger.
Way bigger
Yeah.
next cycle.
Yeah, and to bring it all back to, like, this is anti-fragility in action, and you can only have an anti-fragile system if lessons are learned, right?
Right.
And so if you prevent the lessons from being learned because you're, daddy government and you're stepping in,
You have training wheels. You never learn how to ride a bike.
You never learn. So crypto can never be as anti-fragile so long as USDC is being,
I mean, you can go all the way down that, or Ethereum is very centralized. All these things are.
Yeah, and so Bitcoin, it has that leg up of, like, it is truly anti-fragile because there's nothing holding it up.
Nobody controls it. Nobody can change it. No one's backstopping.
Nothing
There's
at
no
all
bailouts
whatsoever. So it's the most anti-fragile system because it's just doing its thing, and we have to learn the lessons to accommodate how our actions can best interact with Bitcoin and not any other version of that.
Crazy times, Jesse. Crazy times. Yeah. I have a couple more things I definitely want to cover while I have you. There's an interesting perspective that I had never considered before in this fractional reserve Ponzi banking system we have. So Caitlin Long in Wyoming has been trying to stand up this new bank called Custodia Bank. I forget what was she called it previously before Custodia?
Oh, I forget.
But she's been trying for years,
Yeah.
and she needs the Federal Reserve's permission
Yep.
to enter the Federal Reserve System. And the whole idea of her bank is, instead of being fractional reserve, where you have a 0% reserve requirement, she would hold herself by charter of the bank to 108% reserves. So if you put in $100 and you're a customer of the bank, they would hold $108 in reserve for your deposits. And as a result, Avanti was the name of it.
Right.
Thank you, Vince, in the comments. As a result, if all the depositors pulled out their money, they would get their money, as one would expect a bank would work. They hold your money and they do it. And then everyone says, oh, how would that bank make money? They would charge fees. They would charge transparent fees for offering you protection over your money, which historically, before the fractional reserve banking system, was how banks operated. It was a reputational business that you were trusting someone else to store your wealth for you, and you were paying them in return for that. Now, there was always a Bitcoin and crypto element to it. She wanted to bank Bitcoin companies. People don't realize, like, the reason Tether exists in the first place is because we used to have a banking blockade on Bitcoin companies. It was really hard to get Bitcoin bank accounts. So there is a Bitcoin crypto element, and a lot of people said that's why the Federal Reserve wouldn't let her in. They denied her the most recent time, like 2 days before they bailed out SVB and announced all this other stuff.
Yep.
And Lynn Alden made a really interesting point that I never considered, which is, in a world of Ponzi banks, if you have one bank that is responsible, that is very safe, all the deposits, or a significant majority of the deposits, will run from the Ponzi banks to the safe bank, and you will actually bring down the entire system. You can't have a full reserve bank in a fractional reserve banking system, because, and in this exact situation is exactly where it could happen, where people start losing confidence, they start running, and they all run to one or two banks that are deemed safe, not because they're going to be bailed out by daddy government, but because they're actually practicing full reserve.
Yep.
That's crazy.
If you've got a barrel full of bad apples, you can't have a good apple in there to really show how bad all the other apples
Everyone
are.
will run to the good apple.
Yeah. And that's exactly what would happen right now. And it becomes a systemic risk to this shitty fractional system. So it's a funny logic of, like, it actually makes sense from the regulators' point of view that they can't introduce this risk by allowing a decent actor.
I mean, to be clear, they don't say that's why they're not doing it.
Yeah, of course not.
But I never thought of that perspective of it.
Yeah, I think I saw the same tweet, and I also was like, oh yeah, that is that is how money would flow. It would be a net, osmotic flow towards a safe bank, which would put at jeopardy the unsafe banks.
And it was so funny, like, there's 2 different, conclusions people can come out from that. I had a bunch of Bitcoin friends reach out to me, they're like, "Matt, you have a big audience, like, you have to put all your weight behind supporting Custodia Bank, like, this is the fight." I was like, "No, this is not the fight. This Bitcoin fixes this. They will never." I was like, "Now I know for sure they will never let that bank happen unless everything fucking collapses first,
Yeah.
because they can't let it happen. If they let it happen, it'd be even more chaotic than it is right now."
Yeah, with Caitlin's presence online, I've always like it seems to me that she has some faith that, in the system still.
I think they're suing the Fed.
Yeah, and I think she's been surprised at the roadblocks that have popped up in her way of like, no, you can't do this totally honest version of a bank. Like, and I think that surprise comes from a place of like she's been in this world her whole career, and I think she believes that these are good people, and that they can obviously see that this is a good and honest business model, and so they'll allow it. Um, and I was hoping that she knew something about like the decency of the system that was still there, and I think that
Right, that
this,
we were missing something.
yeah,
And I have to be clear, I have tons of respect for
oh yes,
Caitlyn. Like,
completely. I think
I'm
that,
not rooting for her to fail. I just am am jaded and pragmatic about the system that, especially from this perspective, like, they just can't let it happen.
yeah, I would love Custodia Bank to exist. I would probably use Custodia Bank, and that's why they can't allow it, right? Uh, and so yeah, this whole time that Caitlin's been on this crusade to try to get this version of banking out there in the wild, I've been hoping that what she sees or what she believes is possible was actually possible. But I think the cynic in both of us was more right on this one.
Yeah, that's crazy. I mean, I will say, I mean, they burned a lot of money trying to stand up that bank. Um, so, I mean, it's up to those investors whether or not they think it's worth it. But to have the contrast and the perspective of this bank literally could have existed and you denied it 2 days earlier because it would break the whole
Yep.
system that is failing right now, to me is a massive benefit to humanity, that distinction is so clear as day because of the effort she put in and the money that investors, essentially burned trying to support Custodia's mission.
Completely true. Like if the takeaway from that for people who are paying attention, and that's probably the big key here is you have to be paying attention in order to learn that lesson here of like, no, they really are not going to allow uh, decency in in banking, because the system is so fragile that it can't allow that.
Yeah, so then the ultimate conclusion there in my mind should be, you can't ask permission from, if your solution requires permission from the corrupt individuals that are in charge of the corrupt system we already have, you are doomed to fail. And that is why we need Bitcoin in this world, because it doesn't ask permission. It just routes around the entire system. It gives every person the ability to just say fuck you and opt out.
Yeah, yeah, that completely. And I, obviously you focus on that side of Bitcoin more than I do. I tend to just get obsessed with what it means to people as a savings vehicle, and how its properties deliver uh, purchasing power appreciation over time.
Only if you hold self custody.
Well, yep, all true. And so it is just amazing that Bitcoin has managed to deliver such an incredible value proposition in terms of you know permissionless finance, and simultaneously this is the best savings vehicle ever.
Right.
It's just incredible that those two can simultaneously exist in one.
But you need both together. Otherwise, it doesn't. Like,
It's
if the token Bitcoin doesn't have at least stable value, um, then you can't actually transfer value using the protocol, and it's impossible to have stable value without a trusted third party. So the result is a strictly scarce deflationary token, because that will increase in purchasing power. You need to have it at least, can't go down in purchasing power.
Yeah.
Otherwise, you can't. It has to have some kind of value. It needs to accrue value over time.
Well, like Satoshi could have made the mistake of releasing all 21 million Bitcoin up front,
Right.
and then there would be no incentive to adopt. Like,
Right.
like, yeah, you'd have this permissionless network, but you wouldn't have a reason to hold your Bitcoin, because you are recognizing the mechanics in place, and you're speculating that the Bitcoin you hold today will be more valuable 4 years from now.
Right.
And so then you wouldn't have this flywheel of adoption, this network effect that has this viral coefficient that's positive and leads to people.
And
More
specifically
people
with
adopt.
mining, you're able to get into this system without permission from existing holders.
And that's
Because
brilliant.
with proof of stake, you literally need in a pre-mined proof of stake situation, you need an existing holder to sell you the token. In a proof of work system like Bitcoin, anyone can plug in a miner, connect it to the internet, and provide work, verifiable work, and get paid out in Bitcoin without anybody's permission, period.
Yeah, it does it ever, like, I'm sure it does, but does it ever just, like, hit you sometimes how insane the perfection of these various incentives, like, all combined in this single system are? The fact that you've somehow managed to create a minimum bidder for all global energy, at the same time that you've created permissionless
Yeah, it's
finance,
fucking
at the
insane.
same time that you've created the first ever increasing scarcity, absolute scarcity asset on the global landscape.
I would push back on the word perfection.
Sure.
But yes, it's absolutely insane. The crazy part to me is it's like just the right balance of all these different variables, that when Satoshi originally created this protocol, really hard to comprehend, like, what the different knock-on effects and how this thing would
Totally.
change at scale adoption. And we're still not really at scale adoption, but we're at significantly more adoption than I think whoever created Bitcoin in the beginning could comprehend.
Yep.
And it's almost like good enough,
Yeah. Yeah.
right? Like, rather than perfect, right? Like, and that's the hole the shitcoiners get in, because they nitpick little things, and they're like, oh, what if we tweak this variable or tweak that or whatever? But
It's good enough. And
it's better than anything else.
Yep.
And it's not controlled by anybody.
And then the immutability ends up mattering more than all the shitcoiners
Right.
think. It needs to be. You can't have the hard forks because of that precedent that's set there, and thank goodness that Satoshi got the good, well above the good enough bar,
And then left. And then disappeared. Was humble enough to walk away.
So important too.
Didn't let short-term greed cloud his judgment on that.
Yeah.
There's very few people, and then somehow have the best OPSEC of any person in the internet era.
Yep.
Like, that's insane. Every year that goes by, we're like, no one knows the identity.
No, definitively, yeah. Yeah, I just wrote a piece on this for Citadel 21, who will be having their, I believe their last
the 21st issue, right?
Issue will be the 21st issue, I think, coming out
every copy
oh wow, nice. I have a couple of the first few.
It's hard to get the first edition.
Yeah, yeah. Yeah, so I have been thinking about this and writing about this recently, of like, it's just remarkable that like what Satoshi did for, I think most people, and me until recently, assumed that Satoshi mined Bitcoin because, they believed that there would be value to this thing and they might as well have some. But and maybe you got here years ago, and I think most altcoiners and certainly Bitcoin skeptics haven't gotten here, is I don't think Satoshi really wanted any of that supply. Not really. I think what all Satoshi was doing was making sure there was enough hash power to provide a base for the network to keep it going until there was enough hash rate that he could step away.
Right.
So it was never about accumulating 1 million Bitcoin.
Well, what most people don't realize is, we don't have definitive proof if Satoshi did accumulate that 1 million Bitcoin that
Right.
people point to, the
Sure.
Satoshi blocks or whatever. But even if it was even if that was Satoshi and those blocks haven't moved, those coins haven't moved, doesn't mean that Satoshi didn't, after stepping away from the
Yes.
project or whatever, mine separately and has a completely separate stash
Yeah.
that he's been spending off of this whole time.
Yeah. I think that that's probably likely. I think I forget the exact tech earmarks of this, but there's something about the nonces
The
or whatever
nonces,
that are
yeah.
different with the Potoshi blocks. And so I think that was like a knowingly done thing, and maybe
And then just burn those keys, boom, done.
Yep, and then maybe Satoshi was, like, quietly mining with
Just like
some
a
other
regular computer or whatever.
without
Yeah.
that, tag there. So so in that world, they could easily have 100,000 Bitcoin that's, privately theirs, and
That part really blows my mind, just like the humility and the forethought of
yeah,
that.
and
And realizing that he was a central point of failure.
when I was writing this article, I was thinking about V for Vendetta and how that came out in 2005. And I can't help but imagine that Satoshi was, like, deeply inspired by using this mask to no longer be a man, but instead an idea.
You think Satoshi watched V for Vendetta before he created Bitcoin?
Yeah. I think, not to say that Satoshi would not have made Bitcoin without having
I like
watched
the
that,
take. It's a take.
but I think that was, like, certainly inspiring, assuming Satoshi watched this, uh, which is not guaranteed at all. But I think that the takeaway from that for Satoshi have been like, make sure to let the idea be be the figurehead, and in doing
Right, the
so,
idea is bigger than a man.
make sure that there's no man who can be pointed to and or like manipulated or turned or like all the past transgressions of a human being used against Bitcoin and in terms of marketing or smear or whatever like that. Um, I think that was essential to do, and probably Satoshi would have figured that out without V for Vendetta, but
And most people don't have the self-control or the low time preference or the humility to do that.
yeah,
Like the overwhelming majority of people do not. I mean, we've seen
yeah,
public Bitcoin figures that have significantly less influence than Satoshi ever would have had. And they go crazy on
right,
power trips,
yes,
right? I mean, Roger Ver is like the classic example, but also I would say Barry Silbert is one too.
yeah. I suppose if you embark on creating this thing and you know what it is because you made it, you know that it could take over the world of money, and you know that it could become a $10 million a coin thing, like end state that,
That's also what's crazy is I personally don't think Hal was Satoshi,
yeah,
but that Hal, user number 2 on the network, like some of his Bitcoin talk posts from the early days, just that he could even comprehend
right, that number.
these kind of possibilities,
Yep.
it was insane.
I agree with you, and I also think that is who I say if I'm, if somebody presses me who's Satoshi, I say Hal, because
He was just talking to himself.
I think it's a good person to have been Satoshi, like, and he's gone,
Yeah.
and that's a good, I think that's almost like our responsibility to participate in Satoshi's absence, and to not allow for, living characters being on the list.
I just want to say that if Satoshi, with his amazing OPSEC, also simultaneously trolled us by tweeting out running Bitcoin in 2009 from his doxed account, would be epic. unlikely in my opinion,
Yeah.
but that would be pretty fucking ballsy.
Yes.
Um,
That
and
is
and that's the argument. The argument is no one would believe it's him because that'd be ridiculous.
yeah, yeah.
But still, like,
To have gone through all that and
and
then
then you just tweet it out from your public Twitter account.
because you're expecting that casualness means that nobody will suspect you truly.
Yeah.
Yeah.
Okay, what else? I want to cover this idea that I always kind of pushed back on the Pomp school of Bitcoiners for many different reasons. But they had this one idea that I also kind of pushed back on the get off zero, like go to 1%.
Mhm.
Um, I kind of question, to me, I mean, maybe I actually do kind of agree with get off zero because I think that's part of why stay humble stack sats is important because people have trouble dipping their toe in the first time. Like people will go back and forth and be like, oh, like if you had just aped in at this point instead of starting your DCA and slowly accumulated Bitcoin, you'd have way better performance or whatever. But that misses the point because most people aren't willing to just simply put their life savings in Bitcoin and then they get into decision paralysis. So if they just put a little bit in, they get comfortable over time, and then ultimately it ends up just eating their entire net worth, and it's just all they hold is Bitcoin. Um, but I think we're kind of seeing this play out on the corporate side
Mm.
now. Most Americans have just been absolutely crushed by our economy and our financial decisions at the federal level for years, to the point where most of their savings are under the FDIC insured cap, the 250K cap. So it doesn't really matter which bank they're in. They already have this guarantee on paper that if worst comes to worst, the government will debase everybody and give them their 250K or less. But with SVB, it was a very interesting aspect. And maybe it's a different perspective for me because now I'm a partner at the largest Bitcoin only venture fund. But like these corporate bank accounts are significantly larger than 250K, right?
Yep.
These are companies that maybe raised $5 million and they're trying to figure out where to safely put that money, right?
60
And
60% of all deposits
at
are
SVB,
in the whole banking system are over 250K.
right? And a lot of them are corporate accounts.
Yes.
And SVB specifically had a significant majority were corporate accounts, so they a lot more than like your average regional bank or whatever. That is just banking small communities and has smaller balances in each individual account. Um, these companies were in a situation. I have a friend who she works at a non-Bitcoin tech company. They had their entire treasury. It was a hot startup. Uh, and their entire treasury was at SVB,
Hmm.
right? And on Friday, the call went out from the CEO. We're not going to be able to pay payroll, and we don't know when we're going to be able to pay payroll. And I think there's a very strong argument, and I wonder how. I mean, there's a massively strong argument for it, but I wonder how much the perception changes among those founder types where yes, Bitcoin is volatile short term, but if you have 10% of your treasury in Bitcoin self custody or collaborative custody with something like Unchained, where it's not rehypothecated, where you have a threshold of your keys, um, you insulate yourself from those situations where you can't pay payroll, where you can't pay business expenses, where you can't pay all this different stuff. Like maybe you still keep 90% or 80% treasury in different banks, and then you do the crazy split thing where you have 2.5 million across 10 banks, so they're all
Right.
under
Yeah,
the
yeah.
FDIC insured amount. But I think it'll be a wake up call for a lot of these corporate types that it's prudent and the classic example is like the Michael Saylors of the world where they like the entire treasury is in Bitcoin and then they leverage up and it's even more than that. But there's strong arguments that can become very reckless if your company is trying to do something other than be a Bitcoin holding company. But a 10% allocation or a 20% allocation, and these are large numbers. I guess, Jesse, what I'm asking you, are the institutions coming? Like, are the corporate accounts coming to Bitcoin?
Yeah. They are, but just like everyone else, every other type of adopter, it's a adoption curve, and I think this moves the needle. Like I hadn't thought about this aspect of the outcome here of how this makes the case for Bitcoin a little bit better, quite a bit better, for exactly what you said. That makes sense. You have to think about it though, or you have to hear about that idea, and the odds on people getting there are low for the most part. However, there's some group on the margin who are very close to getting Bitcoin, like very close to incorporating Bitcoin into their treasury, probably because they already believe in it, but maybe they've felt like it's too much of a fight for me to have to justify this to my VCs. So I'm not going to pick that fight. But now this happens and they see how this could have protected them. And now they're going to pick that fight.
But even more than that, because like the argument that the Sailor school of thought is that you keep your treasury in Bitcoin because you want to not get debased, the melting ice cube, right?
Yep.
A portion of your treasury, should be long term held in Bitcoin to accumulate that increased purchasing power. This is a flip of that script to a degree, right? It's constant liquidity all the time.
Yeah.
And I think there's an argument. So, like with SVB, which was really interesting, is a lot of VCs banked at SVB. And then they would tell their founders they had to bank at SVB.
Right.
There would be loans contingent on them banking on SVB. They were telling them to do it. I wonder how many, and I mean, there's a whole nother aspect that a lot of these VCs are just straight fiaticians and, you know, they get wiped out like the dinosaurs. But there could be a situation. I mean, we're a Bitcoin VC, so we've always been telling our companies this, but they go to their founders and they say, I'm going to fund you. I'm going to give you this $2 million check, but you have to put a portion into Bitcoin just in case the bank fucking runs.
Yeah. And it's possible that like VCs like Tim Draper might do that, who are fundamentally in the fiat world, but believe in Bitcoin. And now they see, I mean, what we talked about earlier was like, I'm obsessed with how Bitcoin grows purchasing power over time. And, there's this whole other world that you're much better at about like the value of permissionless finance. And the MicroStrategy school of thought has been, I want to own the ice cube that gets bigger. I want my purchasing power to grow.
Right.
So they made that choice, that move strategically entirely because of the store of value properties and the the halvings and why Bitcoin goes up, number go up. But now this is the first time I think where we've seen permissionless finance have enough of a leg to stand on that it overcomes the dismissive thought of, you don't need that because you're not doing anything shady.
Right.
You haven't needed Bitcoin's permissionless properties because if you're a VC funded company, you haven't needed it, but now
you have access to the quote unquote best banking system in the world.
Like, and now that's faltering. That? So you might want some permissionless flow of money. So yeah, I think very few people, sadly, will get that message out of this, but some will, and that even if it doesn't persuade some people, it adds to the case. It adds to the overall Lindy of Bitcoin as a thing that could be useful to have as part of your strategy.
It's super interesting to me.
Yeah, and I think that's how adoption moves, right? Like the entire world is hearing about Bitcoin and for the most part dismissing it, but they cannot help but file away how Bitcoin's reputation has shifted over time. Like, you hear about it in 2013, it's just drug money on the internet. Like, I don't want to touch that at all. And then, fast forward a few years and MicroStrategy is doing this thing. You hear about it. You're like, okay, maybe that sounds like a bold gamble. But just in there, you've shifted from drug money to bold gamble.
Right.
And that trend continues until some tipping point for you individually, some point where the activation energy of you deciding, okay, I can't miss out on this anymore, is enough. You've cleared that activation energy and you buy some Bitcoin. And maybe it's 1% to start, but then you start learning about Bitcoin and inevitably it'll grow.
Yeah, I mean, I can see the framing, like, and you see this in the VC world all the time. Like, how much runway do you have, right? Well, maybe 3 months runway should be in Bitcoin so that you can run this business for 3 months regardless of what happens.
And it's an exciting thing for Bitcoin VCs to be, like, championing.
But then if you think about it that way, like, it's the opposite rebalance strategy too, because the rebalance strategy of melting ice cube theory is the purchasing power increases, so then you rebalance down in your Bitcoin position, if purchasing power increases because it becomes too much of your treasury. In this perspective, if Bitcoin goes down 80%, you need to add more Bitcoin to your treasury to make sure you have your 3 months, runway.
Yeah, true. That's true. Though, yeah, on net, you would expect it to go up over time so that you only need to hold a smaller and smaller amount in order to
Yeah,
meet 3 months of pay. Yeah,
it's interesting.
yeah.
And then last but not least, so I'm not like a Fed tea leaves guy, but maybe you are. So the next Fed meeting is in a week.
Mhm.
And I guess would the ECB meets first, or the ECB is tomorrow?
Yeah, I'm not sure, actually.
What are you thinking on? Is this the pivot? Is this like does the Fed keep raising rates, or do they raise it less than? I guess the expected before all this happened was supposed to be 0.5%, 50 basis
Yeah,
points.
25, 50 basis points was the expectation, and now it's a big question of what are they gonna do now? Um, it's possible they could still raise because having put in this, like, infinite backstop, they could say, "We'll put you more underwater, banks, but it doesn't matter because we'll backstop you anyway." So they could, like, gives them a path to do it. But I think right now the most important development in finance, as far as I'm concerned, is what Zero Hedge just has been tweeting out of the change over the last week in the Fed futures rate. So the expected Fed interest rate, um, over time into the future. So and looking forward 1 year is kind of the most helpful, or the end of this year, what's the most help that's the most
Yeah, like
helpful
the
thing to look
market's
at.
pricing in a pivot, basically.
Yeah, so before all this happened, the
Those charts are crazy.
yep, it's incredible to watch happen day by day. Zero Hedge tweeted out, like, this same chart over the last 7 days and how it has changed. So a week ago, it was, we were expecting the Fed futures market was expecting, and these are the smartest people out there on this topic. They were collectively expecting a 1% hike in rates over the next year a week ago. And that has changed, has dropped rapidly day by day over the last week.
He's almost showing like 12-hour changes, right? This is the Zero Hedge account, right?
Yeah, the most recent one, yeah, he's got 12-hour changes. And now the Fed futures market is expecting a 1% drop in the Fed rate a year from now. So 2% swing in expectation over the last week.
Yeah, that's insane.
Yeah, and that signals that this market, the Fed futures market, thinks the pivot is here. That's what that means, and that means that they're saying they can't keep going. The tightening regime they've been on has broken. The
But
Fed
that
has to
futures
blink.
market was wrong
Yeah,
at this whole time.
yeah, they are always wrong, and they're always the fastest to incorporate the changed environment at the same time. Like, the longer term, they're always wrong, but near term and trend wise, they're right.
But anyway, that means essentially, I mean, I'm pretty sure we're in QE5 right now. The next easing cycle has begun,
Yeah.
and
The
that means assets should go up,
yeah, so
right?
we
And
had
Bitcoin should go up the hardest.
we
Is the Bitcoin thesis essentially, right?
Yep. We've had 14 months of QT before the Fed now has to blink, in my opinion. They can't keep going. And then it's about hard assets, doing great. when we print money.
And then inflation is going to run even hotter.
And inflation is going to run even hotter, and that's why, like, that's sort of cements this 1970s reality for
But it
us.
could be hyperinflation, right?
Yeah.
Like it could just run completely out of control. Like, am I crazy for just? I'm operating under a hyperinflationary environment.
Yeah,
Like pre-hyperinflation.
and I think that's where this inevitably goes. But I think that the public confidence in our institutions, in the dollar, and so on, allows the Fed some runway to, in particular, allow inflation to run hotter than interest rates, and in doing so, bring down the debt burden, the debt to GDP burden, which is now like 130% debt to GDP.
How does it bring it down? Oh, because the interest payments are lower?
So if your GDP is growing because inflation is hot, so your nominal GDP is going up, but your debt burden is not growing as fast, and you're not paying as much interest on that debt burden because you're holding interest rates below inflation, then you can allow the numerator to grow faster than the denominator.
Wait, so can we talk about this? Let's just unpack this for a second because I'm a little bit confused. The U.S. America has this unique privilege where we're able to print the money that our debts are denominated in.
Yep.
Like if Argentina doesn't like get to pick the interest rate they borrow money from people. Like if I mean Argentina has gone through multiple defaults, and as soon as there's a little bit of concern, their rates go crazy, right? I think there's a stat like Argentina's never paid out a 30-year bond or something.
Nice. Wow. Yeah.
There's a situation. Am I correct in thinking that there's a situation where inflation keeps running hot, and then the U.S. dollar loses reserve currency status, and then we stop being able to borrow denominated in dollars? Or I jumped a step. Maybe we lose control of the rate that the U.S. government can borrow at. Like, why are people willing to lend the U.S. government money for 30 years at 5% when they have a horrible track record?
They're increasingly
and inflation's increasing.
So who is buying this debt?
Yeah.
Increasingly not other countries.
It's mandates, right? It's like bank mandates and stuff.
Yeah, so we're pointing a gun at people and saying, like, you will buy some of our newly issued debt. But then increasingly, the buyer of last resort is the Fed. So where this goes is Japanification of, like, the central bank owns all
This
of
is
the
what debt monetization is, right?
Yeah, and it's kind of the inevitable stage right before hyperinflation, or like leading into hyperinflation, and that we are now beginning, in my book. Like,
have you read The Mandibles?
I haven't read The Mandibles. I know you're a big fan. I haven't read that one.
I mean, fan's an interesting word, but
yeah. But I think that
kind of what's going to happen.
Yeah, I guess I don't even know enough to opine on.
It's just U.S. in the hyperinflationary environment.
Okay. Yeah, When Money Dies is how it goes. Like,
I think she just read When Money Dies and then made a fiction book about it, set in New York.
Okay. Then yes, that's going to happen. That's the inevitable end of any fiat currency, even if you are the reserve currency of the world. This is the dollar milkshake theory, where when we pull this stunt, where we're going to let inflation run hot, and interest rates, are going to be high, but not as hot as inflation. We crush other currencies that have to pay their debt in US dollars, and they have to source that from somewhere. So they print more of their stuff in order to come up with the money, by trading that into dollars at worse and worse rates. So they screw over their currencies fast,
right.
And then the dollar is the last one standing.
We export the inflation abroad everywhere.
Yep.
And the weaker economies collapse first.
Yep.
And then the U.S. dollar collapses.
and then we're
And
the
then
last one standing, but we still owe all this money, and there's nobody left buying. So we print it, and the Fed buys it, and all we're actually doing is debasing existing dollar holders.
so then my theory at that point, then the confidence in the dollar gets lost. Then the world tries to move to some kind of commodity-backed currency that inherently requires trust because someone's got to be actually holding the commodities that back it.
Yep.
And then that proves to not work because trust just completely breaks down. And then Bitcoin standard.
Yeah.
That's kind of what I'm operating under.
Yeah. I think like the BRICS nations will come up with their like gold, oil backed currency, and that'll be like an option for people to shift towards. But why are you going to do
But
that?
then they'll rug each other is what's going to
Exactly.
happen.
Why would you do that? Why would you trust China to, invest in their currency? That seems like a fool's errand when you could trust a trustless store value asset.
Right.
So all roads lead to Bitcoin ultimately.
So
And
freaks can just ignore our last 2 hours of conversation.
yeah,
They can just stay humble and stack sats, and
yeah.
they should be in a very good place compared to everyone else.
If you have somehow already found the conclusion, which is the case if you're listening to this, then this doesn't really impact you because you already know to just accumulate Bitcoin and, keep your head down and keep your exposure
Not
to
get wrecked along the way.
the dollar and everything else minimal. Yeah.
Lower expenses, increase cash flow, and put it into Bitcoin long term,
Yeah.
aka stay humble, stack sats.
Yep, you nailed it
Don't get
there.
wrecked.
You nailed it with that one. In fact, you've got this Citadel logo of yours, and I used it in my American West article of this great story of the earliest Oregon Trail, the first like big wave of adopters from 1839, going from Illinois to Oregon, and there were like 19 of them, 19 men just gonna go make their futures, and they carried a flag with them, Oregon or the grave. So I used your Citadel
Ride or
thing,
die.
created a Bitcoin or the grave.
Well, this was made by a rider. The flag was made by a ride or die freak, and he sent it to me.
Oh, cool. That's awesome.
It's pretty awesome. Jesse's looking at the flag that sits behind me in the studio, the Citadel flag. Jesse, this has been fantastic. I mean, we have 150 people coming to Bitcoin Park today for our monthly meetup.
Standing room only.
Where we're going to be talking about the economic incentives of Bitcoin, which we had planned almost a year ago already, which is insane that it's happening during the bank crisis. But there's probably people already outside getting ready for it. Me and you are doing a panel. We're going to have to switch it up a little bit.
Yeah.
So I mean, before we wrap it up, do you have any final? First of all, I want to thank you for joining me for the third time.
Thanks for having me.
That's one of there's very few that have been on the show that many times. First time we've ever met in person. We've only been internet friends.
Yeah, it was for everyone out there. It's surreal to meet Matt in person. The gravitas is very real.
I appreciate that. Do you have any final thoughts for the freaks?
Well, I guess I sort of covered them already there. Of like all this points back to is stay humble and stack sats. It's just that the world is still on the old model, the model that you're told to follow, and increasingly things are going wrong, and increasingly people are going to be like, wait, this isn't supposed to happen. I don't like this. What can I do about it? And then that leads inexorably towards people taking interest in the solution that has already existed for the last 14 years and increasingly will be adopted.
Well, thank you, Jesse. Huge shout out to the freaks who joined us in the live chat and the freaks who continue to support the show with Bitcoin. Reminder, you can support the show by going to saledispatch.com/donate. While this all unfolds, freaks, I would like to remind you all that the stakes are high for a lot of people out there that don't know any better. that have just been absolutely destroyed by the system over and over again. People are going to lose their jobs. People are going to lose their livelihoods. Don't be assholes. Um, just be kind, but don't be naive. Take care of your own. Help your friends and family. Stay humble, stack sats, and I'll see you next time. Thanks all. Thanks, Jesse.